Hello, welcome again to Hybrid Accounts, and let's proceed with our topic, cost of capital. All right, in the last session, we just took a look at introduction of cost of capital and sources of capital, and now we are just starting to determine the cost of equity is one source of finance. So, how do we determine the cost of equity? All right, now as per financial reporting, equity can consist of all the following. It could consist of share capital, share premium, all right? Could consist of retained earnings, but also other reserves, like revaluation surplus, such things, right? Okay, now this is not our concern here. We have not one thing. New funds from equity holders can be obtained in several forms. Maybe it could be obtained from the new issues of shares or from retained earnings. And now retained new issue of shares obviously has a cost. No problem with that. It obviously has a cost. But now you ask yourself the question, oh, does the cost of retained earnings exist or not? Does retained earnings have a cost or not? That's what we are asking ourselves here, right? All right, now, if we encounter a question like this in an exam, we would say, yes, retained earnings have a cost. Which cost is that? When you retain the earnings, it means that you make investors for shareholders forgo the opportunity to pay dividends that could be maybe invested elsewhere. So you have to understand that. So the question, that the cost of retained earnings exists, you ask yourself this question here. So if I told you the cost will exist here, all right, pleasure to be here, pleasure to see you too. Now you ask yourself, yes, by retaining the earnings for reinvestment, it means that shareholders will lose the opportunity of receiving dividends. All right, and therefore you can say that the rate of return that shareholders would have earned had the profits been distributed to them. Because if profit were distributed to shareholders as dividends, they could have invested them elsewhere. So it means that there is an implicit cost. There is a difference between implicit and explicit cost. When speaking of implicit cost, you do not see it obviously, but it is incorporated there. An explicit cost is something obviously paying dividends, paying interest, things like that, right? So cost of retained earnings would usually exist. Now, you have not one thing. This is usually cheaper than the other equities. Why? Cost of retained earnings compared to other components of equity is usually somehow cheaper. For reasons like, let's say, no cost of issue. Retained earnings are readily available to the company. So when they are needed, you do not need to issue them, so no cost of issue. And that reduces the cost of capital. Right now, let's take a look at the approaches that we'll use to compute cost of capital. We usually use two approaches that are dividend growth model, or sometimes it can be extended and just say dividend evaluation model. But this dividend growth model is also known as the golden growth model. But also you have capital asset pricing model. These two models are very, very essential, especially capital asset pricing model, because it can be used in a lot of topics, not just cost of capital. All right, now let's start with dividend growth model and see how it usually occurs. All right, the dividend growth model can be used to determine the cost of what? The cost of equity. What do we mean by this? Regardless of the cost of capital that you lend, we usually consider it to be IRR. IRR is the internal rate of return that makes the left-hand side and right-hand side equal. So simply speaking, we say that the cost of equity using DGM here is the discount rate at which the sum of present values of future dividends is equal to the current market price exclusive of current dividends. Do not worry about this. We're just going to take a look at this in a formula. Now, take a look at this timeline here. Let's say you have year 1, year 2, year 3, and then the assumption of dividend growth model that dividends are paid infinitely. So year 1, year 2, year 3, year 4, year 5, up to infinite, right? And let's say that dividend growth model assumes that dividends grow at a constant rate. So suppose at this current time, the dividend was D naught. The dividend at year 1 would be D naught times 1 plus G. That means it has grown. The dividend at the end of year 2 would be D naught 1 plus G squared. At the end of year 3, D naught 1 plus G power 3. And at year infinity, D naught 1 plus G plus infinity. Now, from the formula above, we just said that the current market price exclusive of dividend, this one, current market price ex-div, that means exclusive of current dividend, should be equal to the sum of present values of future dividends. That's why I've written here present value of future dividends. Now, as you can see there, it could be denote 1 plus d over 1 plus cost of equity plus denote 1 plus d squared over 1 plus cost of equity, but squared, and then I will proceed the same way until I reach the final point. Now, if you just take a look at this, and if you have gone through time value of money, you would recognize one thing here. The thing is, this dividend grows at a constant rate and it goes to infinity. So this means this is a perpetuity and it is growing. So we say this is the formula for growing perpetuity. And if you have studied the time value of money, you would note that the present value of a growing perpetuity is given by this formula here, cash flow 1 over R minus G, where cash flow 1 is the cash flow received at the end of year 1, which in our case here is denote 1 plus G. R could be the discount rate, let's say the cost of capital in our case, and G the growth rate of dividends. So plugging our formula there, this present value with the P naught X div, the current market price exclusive of dividends, and then CF1, the cash flow 1, which is here, denoted in brackets 1 plus G over R minus G, that is cost of equity minus G. So all we need right now is just to make the subject the cost of equity. So making the subject cost of equity, we can in fact make cross multiplication here, and it will be KE minus G equals not 1 plus G over P naught. And then this G would come to the right hand side and add it, and you would arrive at this formula here. So cost of equity would be equal to d naught 1 plus G over P naught X div plus G. Now be very careful when you're applying this formula in an exam. If you are given the dividend at the end of year 1, you do not need to multiply by 1 plus G. We multiply by 1 plus G because we only have D naught. But if you are given the cash flow 1 already as not 1 plus G, just plug it there at once. Right? So that's what you should spot. Okay, now, if there are issue costs, in case there are issue costs, when you're making new issue of shares, you have to pay for issue costs. So in case you are given issue cost in exam, they should be deducted from current market price because the current market price should be the sum of the future dividend plus the issue cost, right? So you have to deduct them from the P naught X div here. All right. And lastly, we'll say in case the dividend valuation model is used, let's say there are no growth. That means G equals to 0. Then cost of equity can simply be taken as D over P naught X D. Just presume G to be 0. If G is 0 here, it will be 1 plus 0. That will just be D naught over P naught X D plus 0 again. So this formula here for cost of equity would be reduced to this one. So that's what I needed us to understand. All right. Now, if you have just seen the assumptions, let's just go and take a look at those assumptions. But first, let's take a look at the abbreviations. KE means cost of equity. G is the growth rate of dividends, and B naught equals current dividend, while P naught X div means current market price exclusive of current dividend. So if the question says that dividend has been paid or has just been paid, it means that this price is X div. But also we can have P naught cum div, current market price cumulative of dividend. This is the current market price inclusive of the current dividend. The question says the current dividend is just about to be paid. That means it hasn't been paid, and so it is incorporated into the P naught cum div, right? So that's what you should spot very well. Now, the relationship between X div and cum div is P naught X dividend equals to P naught cum dividend minus D naught, that is the current dividend. All right, now we can just proceed and take a look at the assumptions of the dividend growth model. But first, let's take a look on how to determine the G, that growth rate. How do we determine the growth rate of dividends? Now we have several methods, and method 1 is usually the analysis of the trend for some years. We just check the trend of dividend, the way they are increasing, because this is about dividend growth model, so we expect the dividend to be increasing. Now, you just have to compare the earliest dividend, is shortened as the E, and the latest dividend, the L. Just compare them and use the concept of time value of money to arrive at the answer. Now, by time value of money concept, we know that future value equals to present value times 1 plus R power n. So the future value would be this latest dividend, the L, equals to the present value. You could just call this DE times 1 plus G power n minus 1, where n is the number of periods given. So if you are given 6 different dividends, n would be 6 minus 1, that is 5. You are given 7 dividends, n minus 1 would be 7 minus 1, that is 6, all right? Okay, so all we need here is to obtain the value of G. So if you make G the subject here, you would have to divide by DE, and then arrive at this figure of G. So to arrive at the figure of G, growth rate equals to the L over DE power 1 over n minus 1 minus 1, the whole result. So this is the first approach on how to determine dividend, on how to determine the growth of dividend, and it is very common in exams. Now method 2, Gordon's growth approximation. Now, we believe that dividends that are paid to shareholders grow due to some funds that are reinvested. Profit is earned and it is reinvested to the business so that the business can grow and it can be able to pay much higher dividends. So, the Gordon growth approximation growth rate is determined as follows. You just take B times R, where B equals to the G equals to the periodic growth rate of dividends as usual, let's say annual. Then B equals to the proportion of profits that are retained. Let's say you have earned the profits of $1 million, but actually you have decided to retain $0.6 million. Then the percentage is 60%. So the proportion of profits that are retained, that could be say as 1 minus dividend payout ratio. All right? And R equals to the rate of return on new investments, or maybe I could simply call it return on equity. It becomes much easier, return on equity. No, that return on equity equals to profit after tax over equity. And method 3, actually method 3, I've just written it, but method 3 is rare. It is rare, but it can be used when dividends are rising and falling. And if dividends are rising and falling, you can use it, but actually, for example, for ACCA, this one is not used, all right? But it is just there. When you have dividend, maybe they rise, they fall, they rise, they fall. If they rise and fall, actually, that would be very contrary to the dividend growth model, but actually, we usually do it this way. You just take dividend at year 1, you minus at year 0, you divide at year 0. Then just take dividend at year 2 minus the previous year 1 over year 1. Then dividend at year 3 minus year 2 over year 2. Proceeding all the way, and then you come and divide the numbers here. First one, second, third, fourth. So you divide by 4 if there are 4. If there are 5, just divide by 5 to get an average. So now we can find the following points that are the following assumptions. We have assumptions of the dividend growth model. What are the assumptions? First, we assume that dividends are paid every year in perpetuity, as you saw the formula. There are dividends from year 1 to infinity. These are the assumptions of the dividend growth model. But also, dividends grow at a constant rate each year, as you just saw at that example, right? All right. Again, we say that it does not produce meaningful results when no dividend is paid. Actually, this shouldn't be included because it's kind of not an assumption, right? So we can just ignore this one. Just ignore it. This is not an assumption. And then no capital gain impact on share price. We presume that that share price was just a summation of what? Of dividends. So we presume no impact on capital gain or the share price, but only dividend payments. That is a good assumption. Then no taxation. We have not taxed the dividends. But also we say no issue cost. We presume that when we make new issue of shares, no issue cost will be incurred. Transaction cost will be 0. And now we can just say other influences on share prices are ignored. Let's say, for example, inflation. Inflation can make the share price change, or political development can make the share price change. Maybe they can fall, they can rise, but we just ignore them. So among all these points, just ignore this point number 3. It's true, but it's not kind of an assumption, so just ignore it. Now, in an exam, apart from assumptions, you can be told to speak of the weaknesses of the dividend growth model. All weaknesses are based on the assumptions themselves, so it's just the way of avoiding them. For example, number 1, it does not explicitly incorporate the risk. We'll come and see the capital asset pricing model that it incorporates risk directly. But as you saw the formula, for cost of equity, it was not incorporating risk. It just has dividend, growth rate, and the market price, just like that. And the second point, we say dividends do not grow smoothly at a constant rate. From the assumptions, we assume that dividend grow at a constant rate, but that is not usually the case. Then number three, we say that it does not produce meaningful results where no dividend is paid. That's why I said this is the weakness. So do not include it here. Not including an assumption in here. It does not produce meaningful results where no dividend is paid, because if no dividend is paid, that means the share price would be zero, which is totally meaningless. All right. Also, you can say that it does not take capital gains into account. It just considers dividends. Although we say that it is argued that a change of share ownership does not affect the present value of the dividend payments. All right. So we say that it does not take capital gains into account, just like the CAPM does, capital asset pricing model does, but also there is a consideration that, changes in the share ownership would not affect the present value of dividend payments. So it seems that they are just right, but actually, since better method like CAPM incorporate that, I'll just see this as a weakness. All right, number five, no allowance is made for the effects of taxation. We ignore tax on dividend, right? Although it can be modified to incorporate that. And it assumes there are no cost of issue for new shares, while usually when we make new issues, you would incur issue costs, right? Okay, so that was all about this situation. And now I would just like us to go to examples. Let's take a look at these examples and see how we can proceed now. Now, example one. The question says, calculate the cost of equity capital using the dividend growth model. You are given the following information. You have dividend of $6 has just been paid, and the company expects future growth rate of dividends to be 5%. Current market price of the share equals to $50. So you got something like that. So you just have to start asking yourself how you can proceed with this question, right? So just read the question and take a look and see how you can start approaching it. You are told that dividend of 6 has just been paid. By dividend just being paid, that means this is the current dividend. Of course, whether it has been paid or not, even if they say it was about to be paid, this will be the current dividend. So I would say that I have the current dividend that is $6, and then by this dividend has just been paid, you are told that the current market price is $50. Now you have to ask yourself if this market price exclusive of dividend or inclusive of dividend. Since dividend has just been paid, that means dividend is not included in the current market price. So the P0 current market price should be ex-dividend. But also we're given the growth rate of dividend as 5%. So just fill them 5%, that is 0.05, and P0 ex-div, that is $50. So you have to read the question and spot by yourself on whether the price of shares given is ex-dividend, excludes dividend, current dividend, or includes current dividend, right? Okay, so after that, we just go to the formula that of cost of equity equals P0 1 plus G over P0 x dividend plus G, all right? Now just plug in the values and just arrive at your answer. P0 equals $6, G equals 0.05, and P0 x dividend 4 equals to $50 plus G, that is 0.05. You would arrive at 17.6%. Now, just be patient. Let's take a look at another example. The same example, but just the wording has changed. Here we say dividend has just been paid, but in the next section, just be careful on this. The question says calculate the cost of equity capital using the dividend growth model. Dividend of $7 is about to be paid, and the company expects future growth rate of dividends to be 5%. The current market price of the share equals $53. Now be careful. Have you seen that? Here we say dividend is about to be paid. It is the current dividend, but that dividend has not been paid yet. So it makes this current market price to become dividend rather than ex-dividend, right? Rather than ex-dividend. So you have to be very careful about that, right? Okay, so we have the solution here. D0 equals $7, and then we have G, that is 0.055%, and we have P0 come dividend. This one will become dividend, all right? but we need the ex-dividend in the question, in the formula. So P naught ex-dividend would be P naught cum dividend minus D naught, that's the current dividend. 53 minus 7 would be 56, all right? Just like that. And then we could determine the cost of equity as D naught, brackets 1 plus G, over P naught ex-dividend plus G. Now just have to plug in your values here and arrive at the answer. D naught equals to $7. Then G was 0.5%, that is 0.05. But P naught XD, that is 56 plus 0.05. Now plugging those in your calculator and you will arrive at 18.125 as the cost of equity. So I hope now you can distinguish between the terms dividend has just been paid and the dividend is about to be paid. You have to be very careful about that. If you haven't subscribed, you can subscribe for regular updates. Thank you very much.